A man rented desks. He convinced the world this made him worth $47 billion. It didn't. In January 2019, a Japanese billionaire handed a barefoot Israeli entrepreneur the keys to the most expensive real estate company in American history. He had known him for less than 30 minutes. That single meeting inflated WeWork's valuation to $47 billion. More than Ford Motor. More than every major hotel chain in America combined. 8 months later, the whole thing collapsed. In public, in real time, on camera. The man who built it walked away with more money than the 2,400 employees he left behind, combined. The question isn't how he did it. It's why every bank, every auditor, and every board member with the power to stop it chose not to. That answer matters right now, because the same machine is already running somewhere else. Go back to the beginning. A building in Lower Manhattan, mostly empty. 2 men walk through it. One is Miguel McKelvey, soft-spoken, trained as an architect from a commune in Oregon. The other is Adam Neumann, Israeli-born, 6'5", barefoot. Speaking about God, they had a simple idea. Take a large commercial building, divide it into smaller offices, add design, light, coffee, and beer. Rent the space month to month to freelancers, startups, and small teams who couldn't afford traditional leases. Shared office space had existed for decades. Executive suites, business centers, serviced offices. None of it was new. What was new was the frame. Neumann did not call it a co-working space. He called it a community, a movement, a physical manifestation of the belief that work should mean something. The company's official mission: to create a world where people work to make a life, not just a living. That line was painted on the walls of every WeWork in every city, in every country. It was not a business pitch. It was a conversion experience. And it worked. At first, because the underlying business made sense. WeWork grew steadily. By 2014, it operated in 13 cities. By 2015, its valuation reached $10 billion. By 2016, $17 billion. It was expanding fast, signing leases across New York, London, Berlin, and San Francisco, converting floors of underutilized commercial buildings into design-forward spaces that young workers actually wanted to be in. The product was real. The demand was real. The problem was what happened next. And to understand that, you have to understand the world that was willing to fund it. Between 2010 and 2019, Silicon Valley rewrote the global rules of capital. The old logic, profit first, scale second, was declared obsolete. Amazon had lost money for 20 straight years. Uber burned billions and went public anyway. Snap never turned a profit. The market rewarded all of them, because the promise of technological dominance was worth more than current earnings. That was the theory. And for a while, it worked. That premise, grow now, profit never matters, became the operating system of venture capital. It funded genuine revolutions, GPS navigation, cloud computing, social networks that connected 2 billion people. But it also created a secondary effect nobody wanted to examine. A parallel financial reality, where any company could call itself technology, raise unlimited capital, and face almost no scrutiny, for almost unlimited time. By 2019, there were more than 400 private startups, unicorns in the industry's vocabulary, worth a combined $1.3 trillion. Most had never earned a dollar of profit. Many would never be asked to. WeWork was the biggest, the loudest, the most aggressively evangelical about its own mythology, and it was the logical endpoint of everything that came before it. The paradox nobody wanted to say out loud. The same system that funded the internet, the smartphone, and cloud infrastructure had no structural mechanism to distinguish a real revolution from a well-dressed lie. Both used the same language. Both had the same founders. Both raised money from the same funds. The difference was always in what happened when reality showed up. And reality was about to walk through the door, in the form of a Japanese billionaire with a $100 billion checkbook. January 2016. Masayoshi Son, founder of SoftBank Group, a Japanese conglomerate managing one of the largest pools of investment capital in history, sits across from Adam Neumann. The meeting lasts less than 30 minutes. Son doesn't ask for audited financials. He doesn't request a model of the unit economics, doesn't question the lease structure, doesn't probe the distinction between real estate and technology. He hears the vision. He sees the energy. He commits billions. This wasn't entirely irrational. Son had bet on Alibaba in 2000 when nobody believed in it and turned $20 million into $130 billion. He believed deeply in what he called information revolution companies, businesses that could, at scale, reshape the physical world. He believed WeWork was one of them. "I made a mistake," he would say later. "My judgment was really bad." But in 2016, the judgment was move fast, go big, and price in the option value of what WeWork could become. Over the following 3 years, SoftBank committed $10.7 billion to WeWork. Drawn from SoftBank's own balance sheet and from the Vision Fund, a $100 billion investment vehicle assembled from institutional capital worldwide. The Vision Fund's largest single backer, the Saudi Arabian Sovereign Wealth Fund, which contributed $45 billion. By January 2019, after SoftBank's final $2 billion infusion, WeWork's valuation was officially $47 billion. The desk rental company was now worth more than Ford. But to understand how a desk rental company reaches $47 billion and why it was always going to collapse, you have to look at how the machine actually worked and what it was built to hide. Here is WeWork's actual business model, stripped of mythology. WeWork signed long-term commercial leases, 10, 15, sometimes 20-year commitments, on large floors in premium office buildings. It paid to renovate and furnish those spaces. Then it subdivided them and rented them back, short-term, to members. Monthly, sometimes weekly. The structural risk was obvious to anyone who looked. WeWork had long-term liabilities and short-term revenue. In a downturn, when members stopped renewing month to month, WeWork was still bound to pay its landlords for years. That's not a technology model. That's not a network effect. That's not a moat. That's a highly leveraged real estate bet that goes catastrophically wrong the moment the cycle turns. But WeWork had an answer to that: the word technology. Internally, Neumann and his team argued that WeWork's data created a proprietary intelligence layer that separated WeWork from any ordinary landlord. The data made it a technology company. The technology justified the valuation. There was never evidence this data produced meaningful competitive advantage. And there was a more immediate problem: the numbers. WeWork's revenue in 2018, $1.8 billion. WeWork's losses in 2018, $1.9 billion. WeWork's losses in the first half of 2019 alone, $690 million. The company was burning through roughly $2 billion a year. And the losses were accelerating, not shrinking, as it opened hundreds of new locations simultaneously. To paper over this, WeWork's finance team invented a metric. They called it Community-Adjusted EBITDA. Standard EBITDA excludes interest, taxes, depreciation, and amortization. WeWork's version also excluded sales and marketing, general and administrative expenses, design and development costs, pre-opening costs for new buildings, which, for a company opening hundreds of locations a year, amounted to several $100 million annually. Strip out every cost associated with running a business, and yes, you can manufacture a profit figure. It was the oldest trick in the financial fraud playbook. But the self-dealing ran deeper than accounting. Neumann personally owned real estate, buildings, and WeWork was renting at least 4 of them, paying commercial rents to its own CEO while reporting those transactions as arm's-length business. He was the tenant and the landlord, sitting on both sides of every deal. In the same period, Neumann sold the intellectual property rights to the word "we" to his own company. Price: approximately $6 million. He sold a word to the company he ran. Only after the story leaked publicly, and only after widespread ridicule, did he return the money. This was the company about to ask the American public for a $47 billion valuation on the stock market. You might be wondering, where were the people whose job it was to stop this? No financial fraud of this scale happens without enablers. By the time WeWork filed its IPO paperwork in August 2019, 17 investment banks were competing for the underwriting mandate. JP Morgan, Goldman Sachs, Morgan Stanley. Each stood to earn tens of millions in fees from the transaction. Each ran due diligence. Each signed off. 3 separate accounting firms had reviewed WeWork's books at various points. Board members, including executives from major American corporations, sat on governance and audit committees. Nobody pulled the brake. And the governance structure made it nearly impossible to do so. Neumann had engineered a super voting share structure that gave him 20 votes per share, compared to 1 for ordinary shareholders. Even post-IPO, he would control the company permanently, regardless of what any board member, investor, or regulator said. His wife, Rebecca Neumann, held formal authority over who could succeed Adam as CEO in the event of his death or incapacity. Not the board, not the investors. His spouse. This was not governance, it was dynasty. SoftBank, for its part, had a perverse structural incentive to keep the valuation inflated. The Vision Fund's returns were reported on a mark-to-market basis, meaning portfolio companies were valued quarterly based on the most recent funding round. If WeWork's last round valued it at $47 billion, that $47 billion sat on the Vision Fund's books as an asset. A lower valuation was an immediate, direct hit to the fund's reported returns. Every player in the chain had a reason to look away. The auditors, the banks, the board, the investors, every single one. 88, no countdown. And while they were all looking away, inside the company, things had crossed a line that had nothing to do with accounting. The warnings came early. They came often. Nobody acted. Financial analysts as far back as 2017 had published detailed critiques of WeWork's lease liability structure. The argument was straightforward. If WeWork's members could leave in 30 days, but WeWork owed its landlords 15 years of rent, then WeWork was running an unhedged macro bet on the commercial real estate cycle. It was not a technology company. It was a leveraged short position on economic stability. But the external warnings were quiet compared to what was happening inside. Mandatory company retreats, called summer camp, flew thousands of employees to rural upstate New York annually. Not optional, compulsory with attendance tracked. Tequila shots were distributed during all hands meetings. A $60 million private jet and a tiger on a boat at a company event. In March 2019, 5 months before the IPO filing, WeWork quietly let go of 400 employees. No public announcement, no community statement. A letter was sent by email. People came in to find their access cards no longer worked. This was the company that was about to ask the American public for $47 billion. And on August 14th, 2019, it did. August 14th, 2019. WeWork's S1 filing lands on the SEC's public database. 300 pages. Available to anyone with a browser. The financial press starts reading at 8 a.m. By noon, the questions are already printing. The valuation starts moving. 88. Week 1. Analysts suggest $25 billion. Week 2. Investment banks recommend $20 billion. Week 3. The price falls to $15 billion. Week 4. Maybe $12 billion. Week 5. $10 billion. Week 6. Postponed indefinitely. In 33 days, $39 billion in paper value disappeared. On September 24, 2019, Adam Neumann resigned as CEO under pressure from his board and his primary investor. His exit package was worth approximately $1.7 billion. He walked out of the company he had burned to the ground, carrying enough money to rebuild it twice. On November 21, 2019, a Thursday, late in the morning, WeWork held meetings at its offices around the world. 2,400 employees were told their positions had been eliminated. That was 20% of the global workforce, gone in a single day. These were not the executives. These were community managers who had believed the pitch. Operations staff who had signed on for below-market salaries in exchange for stock options. Options now worth exactly zero. Cleaning staff, front desk workers, the people who had actually, physically built the community WeWork was selling. Before the layoffs began, a group calling themselves the WeWorkers Coalition had already sent a letter to management. More than 150 employees signed it. "We are not asking for graft," the letter read. "We are asking to be treated with humanity and dignity, so we can continue living life while searching to make a living elsewhere." Most of them received 4 months severance. Neumann received $1.7 billion, and for the 700,000 members, small businesses, freelancers, early-stage startups who had signed agreements to use WeWork spaces, the situation was worse in a different way. They weren't traditional tenants. They had no leases, no legal standing. When WeWork eventually filed for Chapter 11 bankruptcy on November 6, 2023, members received notices that their locations would close with minimal warning. A small business owner who had used a WeWork address for 4 years. A 3-person design agency whose clients had that address on file. A freelancer who had structured her entire workflow around a WeWork desk in a city where she couldn't afford permanent office space. They had believed the community. That's the point. Here is what the WeWork story actually is. Not a story about a charismatic founder who lost control. Not a story about one man's ego outrunning his business sense. Not a story about Silicon Valley arrogance or a generation that confused mission statements with balance sheets. Those readings are real, but they're the surface. The truth underneath is this: the $47 billion valuation was not created by Adam Neumann. It was created by a financial architecture that rewarded every participant in the chain for inflating it, and imposed the cost of that inflation on the people least positioned to absorb it. Masayoshi Son committed $10.7 billion, not because he was deceived, but because the Vision Fund's structure made it rational to bid aggressively and report high. The 17 competing investment banks each earned fees based on deal size, whether the IPO succeeded or not. Their interest was a high closing price. Every participant understood the game, and every participant had an exit strategy. The people who didn't have exit strategies were the 2,400 employees whose options were worthless before they could exercise them, and the 700,000 members whose agreements had no protections when the company went bankrupt 4 years later. This is not a failure of the system. This is the system working exactly as designed. The WeWork collapse is not an exception. It is an entry in a long series. In 2001, Enron collapsed after using off-balance sheet vehicles to manufacture earnings that didn't exist. It had been named America's most innovative company by Fortune magazine 6 years running. Thousands of employees lost their retirement savings. The executives walked away with millions before the stock crashed. In 2008, the structured finance market collapsed under the weight of securities rated AAA by agencies paid by the banks issuing them. $11 trillion in American household wealth was destroyed. The bankers who designed and sold those products were bailed out. The families who lost their homes were not. The pattern is always the same: a metric that obscures reality, a group of credentialed institutions with conflicting incentives, and a window of collective suspension during which reality is held at arm's length by mutual agreement. When that window closes, the losses cascade down to whoever is holding the bag. WeWork's community-adjusted EBITDA was Enron's off-balance sheet vehicles with a different name and more zeros. The governance structure that gave Neumann 20 votes per share was a less polished version of the dual-class structures protecting founders at dozens of major technology companies today. The Vision Fund's incentive to inflate valuations was structurally identical to the mortgage servicers of 2007, who had every reason to originate and sell regardless of credit quality. The WeWork collapse is not an exception to the system. It is the system briefly made legible. SoftBank eventually wrote down $14.3 billion in losses on its WeWork investment. Masayoshi Son stood before investors in November 2019, a photograph of turbulent seas projected behind him, and said, "Today's earnings are a mess. It's red all over." He accepted responsibility, and then SoftBank moved on. The Vision Fund continued investing. SoftBank's stock recovered. Sun remains in his role. Adam Neumann, who received approximately $1.7 billion to resign from the company he had destroyed, returned to the market in 2023. His new company, Flow, a residential real estate startup, raised $350 million from Andreessen Horowitz, one of Silicon Valley's most powerful venture firms, before it had built anything. The man who torched a $47 billion company raised new money 24 months later. The 2,400 people who lost their jobs in November 2019 did not. The system that produced WeWork did not pause to examine itself. It did not reform its valuation methodology, strengthen its governance standards, or create accountability for the institutions that collectively pumped a desk rental company to $47 billion and then walked away from the wreckage. It was already funding the next story. It always is. If this gave you a new perspective on how a $47 billion number gets built and who pays when it falls apart, subscribe. Every few years, the same architecture gets dressed in new language. The technology changes. The founder changes. The metric changes. The underlying structure stays the same. History doesn't repeat, but the mechanism is always recognizable to anyone who knows where to look. Next, a Stanford dropout convinced the world she had built a blood testing machine that could diagnose over 200 diseases from a single finger prick. It couldn't. But for more than a decade, patients, doctors, and investors believed it could, because the exact same systems that enabled WeWork enabled her too. Theranos is next.